Good afternoon, ladies and gentlemen. My name is Michael Lawson. I am President and CEO of the Los Angeles Urban League. Thank you for attending the third of our web six-part financial series called Black Wealth, Attainment, and Retention Program. These Zoom workshops are brought to you through our collaboration with Parkside Economic Development Corporation. And I want to thank you, Gerald Smith, for partnering with the Los Angeles Urban League in this effort to bring wealth and health information to our communities. This afternoon, we have two outstanding expert financial presenters who will lead the Black Wealth Attainment and Retention discussion on a foundation built on home and business ownership. Both Mr. Daryl Brown, legendary banker and philanthropist, and Mr. David Murphy, tax accountant and real estate specialist, are well known in our communities. They will impart information to help us attain, retain, and transfer wealth to our families. These well-respected gentlemen will be introduced formally to you momentarily. The noted business coach, author, and networking expert George Frazier said the success runs in our race. I look forward to listening to our noted speaker's remarks, affirming Mr. Frazier's statement. Please enjoy tonight's program, and thank you for supporting our outreach to the community.
Good evening and welcome everyone to our third installment of the Black Wealth Attainment and Retention Program that we refer to as BWARP. As Michael said, our topic this evening is a foundation built on home and business ownership. You know, this month, all of our themes seem to coincide with some annual things that go on. And this month we celebrate Juneteenth. In some southern states it's called Freedom Day, Jubilee Day, and others Liberation Day. But it's all the result of the Emancipation Proclamation, or Executive Order 95 in September of 1862 that resulted in 3.5 million slaves to be free men and women on January 1st, 1863. It took 2.5 years, however, for the Union Army to enforce the law in Confederate states, finally reaching Texas on June 19th, 1865. The 13th Amendment abolished slavery in all states. But believe it or not, Texas gets a little of a bad rap because it was actually Kentucky and Delaware that were the last states to free slaves in December of 1865. Tonight's session is designed to encourage our financial liberation through home and business ownership. As always, throughout the presentation this evening, you'll be able to submit questions in the chat that will be answered during our question and answer segment at the end. And as Michael alluded to, Parkside is honored to be in association with the Los Angeles Urban League to produce these 6 workshops designed to enhance the opportunity for our growth, economic growth and retention by sharing legacy wealth building strategies and ideas that can help produce a more financially conscious community. And I want to thank the Urban League for their support, as well as I want to thank the board of Parkside EDC for its support and commitment to BWARP. And most importantly, I want to thank all of you for sharing this evening with us. And we trust you'll take away a nugget of information to assist you in attaining and retaining the financial liberation your family and community deserves. If you want to know more about Parkside EDC, just simply log on to parksideedc.org and you'll see some of the great things we've been doing and giving away $20,000 annually in scholarships and some of the things we're doing in the areas of financial literacy. BWARP is an expansion of our financial literacy efforts to increase the number of African-American property and business owners and plant seeds that will produce wealth that is retained within families and help us sustain our community. BWARP is extremely fortunate to have a group of presenters who are experts in their respective fields and longtime supporters of Parkside. So before we introduce this evening's presenters, I want you to meet our other wealth, attainment, and retention specialists and have them share briefly a little bit about their upcoming workshops. These individuals throughout their careers have shared their knowledge and donated their time to efforts like this that provide needed services to our community. Our next workshop is August 11th, and it features attorney Caprice Collins and Dr. BJ Hawkins. They will be presenting I Will If You Trust Me, a deep dive in the importance of estate planning and the fiduciary responsibilities that can result when not done properly. So in a minute, you're going to hear from Caprice Collins, top-rated Harvard Law School graduate. She has over 40 years of legal experience with successful law practice devoted exclusively to estate planning, trust, will administration, and living trust. Caprice.
Good evening, everybody. Thank you so much for allowing me to be a part of this wonderful organization and the presentations we've been making this year. And I want to just introduce myself a little bit more because I am very proud of my origins. I'm very proud that I'm a second generation Angelino, that I am a product of the Los Angeles Unified School District, attended Dorsey High School, went on to the University of California, Irvine, and then on to Harvard Law School. And so I'm truly a homegrown girl. And I grew up in the Crenshaw district and feel a lot of connection to that community. I'm very proud of the accomplishments that were made during the 60s, 70s, and 80s. And I'm going to be talking a lot about how we can preserve those accomplishments that were so valiantly procured by those generations for those that follow. So let me start by saying that, we need to be aware of just how large the wealth gap is between Blacks and whites in the United States. The average Black household has a net worth that is $840,000 less than the average white household. Secondly, I think we have a tendency to overestimate the significance of home ownership alone as a component of that wealth. If we look at the average American's portfolio, we'll find that home ownership, specifically ownership of a primary residence, is only about 25% of all of the assets that an individual might possess. The other 75% includes business ownership, retirement accounts, financial assets like stocks and bonds, and non-residential real estate. So if we focus exclusively on home ownership in a primary residence, we're going to be ignoring these other components of asset ownership. And it's interesting to note that white non-homeowners have 31 times the median wealth of Black non-homeowners. So home ownership is only one aspect of the package of things that provides wealth to an American family. One of the keys in closing the wealth gap, the generational wealth gap between Blacks and whites, is to protect and preserve the wealth that our community has accumulated to this point, to ensure that it is passed down efficiently to future generations without a court process. And at the next segment that Dr. Hawkins and I will be presenting on August 11th, we're going to be specifically speaking about the proper way to pass wealth down, the proper way to ensure that the right people are there to assist the family at a time when it is most needed, using various estate planning techniques, and how to avoid the dreaded process of probate. So we really look forward to seeing you again on August 11th, and look forward to all of the comments you will make, all the questions you will have about that. And of course, we look forward to our wonderful speakers this evening.
Our partnering with Caprice will be BJ Hawkins, PhD, Managing Principal of One Source Fiduciary Solutions in California, and is a licensed professional fiduciary and trustee and court conservator. Dr. Hawkins is an expert in intergenerational transfer of wealth. BJ has dedicated her career to opening the door for financial opportunities for African Americans. As a competitive tennis player, BJ believes, like life, tennis is a head game that relies on endurance, skill, determination, and follow through. BJ, take a couple of minutes and share with our audience some of the things you'll be sharing with them in our next session.
Well, good evening, everyone. I look forward, along with Attorney Collins, in presenting this section. Because of the prevalence of obesity, hypertension, and diabetes, the Alzheimer's rate in the African American community is almost 3 times that in the white community. When we don't do trust and estate planning, we have an inherent micro assault against intergenerational transfer of wealth. Part of my presentation with Attorney Collins will address examples of the way adult children of senior parents and siblings with parents who are vulnerable can make optimal decisions to preserve that haven't done what they were supposed to have done with an individual like Attorney Collins. The 3 things that I would like everyone on this Zoom call to think about in preparation for our presentation is, number 1, Tom Selleck and the company selling reverse mortgages are not really interested in seniors having money to live a better life. They're interested in acquiring asset. The greatest asset for most Black families will not be passed on. And number 2, if there's not a trust and pulling one off the internet is foolish, it is almost impossible to avoid the costly probate expense when a loved one passes on. And the last is a word about institutional and systemic racism. Banks are prominent in the world of trust administration. And as the first licensed professional African American in the Los Angeles area, the greater Los Angeles area, not one bank have I found in the history of banking in Los Angeles has been willing to address this trust administration problem from looking at it from the lens of systematic and institutional exclusion of Black businesses from this area of banking. Thank you, and I look forward to August the 11th.
Thank you, BJ. And the workshop following that will be on October 13th, and it'll be a presentation entitled Invest Well and Live Well. And we will feature 2 of LA's top investment and stock market specialists, one of which, who is not with us tonight, Joe Haywood, is president and CEO of Haywood and Associates, a comprehensive financial planning firm. He has provided investment insurance solutions for more than 250 clients and manages more than 75 million in assets. Joe is an alumni of USC and a member of Kappa Alpha Psi fraternity that he's very proud of. But he's more proud of the fact that he's a father of 4 and husband. And he's also an executive pastor at New Vision Christian Fellowship and loves to play golf, racquetball, and travel. And Joe's partner at that event will be none other than Justin P. Lacey, Vice President, Resident Director, and Wealth Management Advisor for Merrill Lynch. Mr. Lacey is a graduate magna cum laude from the University of Southern California, where he double majored in business administration and accounting. Justin is a member of the Bank of America Black Executive Leadership Team and the Merrill Lynch African American Leadership Council. He holds the designations of Certified Financial Planner, Certified Public Accountant, and Certified Private Wealth Advisor, and Accredited Wealth Management Advisor as well. Justin, can you share with our audience just a little bit about what you and Joe will be sharing in October?
Yeah, Reverend, thank you for the introduction. I'm happy to share the stage with everyone else. I mean, Caprice and BJ talked about the need for their area of focus in terms of the retention of wealth and the transition of wealth to be able to create generational wealth. And Caprice also threw out those statistics about the average net worth between Black families and white families. And, we all know that what contributes to that is, systemic racism over multiple generations, and Reverend can speak to that more than anyone else. But, even to this date, there are individuals outside our community that are getting access to solutions, getting access to advice, getting access to strategies that are helping keep that wealth gap where it is. And it's extremely important that we as a Black community have Black professionals out there like myself and Caprice and BJ and Joe to be able to advise Black individuals on how they can narrow the gap. And it's up to the community to take heed of these individuals looking to provide us with this information, take advantage of these information, and be able to develop their own finances in a very strong way. So myself and Joe and myself, we're going to focus on investment products. We're going to talk about strategies and the ways that you can most effectively develop your wealth. And our advice is going to be tailored towards anyone, whether you have $100 or $100 million. We're here to give you advice and give you strategies you can take advantage of that's specific and that is implementable for you to be able to develop your finances. And the other thing I'll comment is that, part of what we're going to be commenting on are specific strategies and different products and educating you on the different things that are out there. But, investing and developing your finances, it's emotional more than anything. So we're also going to spend a lot of time talking about, behavioral ways to think about money, behavioral ways to think about saving, behavioral ways to think about investing, so that we not only are confident in terms of our knowledge about the investment strategies to take advantage of, but we understand conceptually and emotionally about how we're doing it and why we're doing it and how it fits within our plan. So excited to share the stage with Joe. If you're not there for me, attend for Joe, because Joe is amazing at this. I'm excited to be a part of this. Thank you, Reverend.
Thank you, Justin. Our last workshop in December is entitled Millionaire Millennials. And on that workshop, we're going to have a panel of young people in that millennial generation, including Justin, who you just heard from. And they're going to be discussing not just how they're going to build their wealth, but the strategies they're going to use to retain the legacy wealth that will potentially be passed down to them. All of our workshops will cover a variety of wealth building and retention strategies. But this evening, we're focusing on building a wealth base with home and business ownership and the tax principles that apply to it, as well as the opportunities for you to get the financing and assistance that you need to accomplish your goals. Our first presenter is David L. Murphy. He's an EA and a CEO and principal of David L. Murphy, Inc., with 34 years of experience in tax preparation, tax accounting, and tax law. David has successfully prepared taxes for residential individuals, small businesses, taxes organizations, and represented all of them before government tax agencies. Additionally, his professional services include real estate and mortgage brokerage services. And when he's not crunching numbers for us and solving our business issues, you may find him riding his bike from LA to San Francisco. David?
Hello, everyone. Can you hear me?
Yes.
Okay. Thanks, everyone, for joining. I'm going to share my screen here. I can share that now, Jacinda?
Yes,
I
you
need
can.
a few minutes to introduce myself. Okay. Let me go and share that. Well, welcome, everyone, to the workshop here. And I take my hat off to everyone for joining. And hopefully, throughout our presentation and at the end, you will present your questions. I find that one of the better ways to kind of share tax information. They gave me 15 minutes to, can you see this now? Everyone can see the screen?
Yes.
Okay.
Mhm.
Gave me 15 minutes to kind of go over some tax strategies, and I'm going to start with some basic information, and towards the end, we'll be able to answer any questions and kind of hit on the areas that owning property, ownership, and a few other tax strategies that will help us. So again, my name is David Murphy. I'm an enrolled agent, and I am the president and CEO of D.L. Murphy, Inc. We basically started this company back in 1986, so we have a few years behind us here. And what is an enrolled agent? That's one of the areas that I find one of the first places to start learning how to save your wealth is who do you go to prepare your taxes. Enrolled agents, we're licensed and authorized by the federal government or the IRS to practice before all levels of the Internal Revenue Service. So we do everything, enrolled agents do everything from basic filling out a W-4 to up to tax court and representing clients. So, so you want to make sure that one of the first tax tips is who prepares your tax returns. You don't want to pay too much if you just have a W-2, but on the other hand, if you have a business, you know, you own property, you own rental properties, you don't want to go, you might want to go to someone who's more seasoned, and that money that you're trying to save in the preparation fees, you're going to make the money back with the advice that they would give you. So you can go to enrolled agents, you can go to CPAs, tax attorneys. There's also CTEC professionals out there who's licensed by the state of California. Of course, the national firms, you know, H&R Blocks, the Liberty Tax and all that stuff. They're friends or family, and now you can even self-prepare your returns. We get a lot of after the fact work where people went to the wrong type of accountant. They didn't know all of the tax laws, or they do them themselves, and we end up going back and correcting them for those type of problems. Let me move some of this stuff out of my way here. So this, another point that I want to get across, tax evasion is illegal. Tax avoidance is perfectly legal. So you want to be able to use the tax codes, which is what your CPAs and enrolled agents specialize in taxes, and we're licensed to represent taxpayers throughout the country, whereas your other professionals may be only for that particular state. So as you can see, the tax code is about 70 pages, but the part that applies to individuals is Title 26 of the US Code, and that's about 2,052 pages, as you can see. But the statutes, the regulations, the case law is about 70 plus pages. Over to the right, you see this chart over here. This kind of gives you the idea of the complexity of tax law, and this is only through 2010. Trump put in a lot of new tax laws in his administration. Biden's getting ready to do more. So it really, depending on your income level, as you can see, the more complex tax law is, the more of a reason you need to go to a professional to have your taxes prepared. Let me go to my next one here. So what we'll cover today, we'll cover some of the new tax laws. Biden has some proposals that are coming out in 2021. I'll briefly hit on that because a lot of that stuff is just proposed. We'll go over a real basic anatomy of a tax return. The key for that to me is what's in your basket on April the 15th, assuming that's your tax filing day, because it really doesn't matter what you make throughout the year. It's basically what part are we going to tax as far as the IRS goes in the state. We'll go over some income, losses, deductions, what is a credit, and eventually taxable income is what you want to get to by April the 15th. You want that as low as possible. We can have $1 million of gross income, but like Trump and who's the other guy from Utah, one of the senators there. Why is your taxes so low? I'll hit on that a little bit. How do we lower our taxes and property ownership and taxes? So these are just some of the new tax proposals that you want to be aware of. The top marginal, which Ms. Collins just kind of got into, top marginal income tax bracket is 37% now. Biden proposed to take it up to 39.6%. Now that applies to people with income over 452, but there's a lot of other changes in the tax law that you want to be aware of and thinking about now in June, meeting with your tax professionals, starting to plan out your year to determine what your taxes will be when you file in April. You don't want to wait until after the 31st of December to determine what your tax liability is. So tax planning is a very important part of wealth accumulation. after December 31st, it's a wrap. Whatever you've done, the taxes will be there. This is a long one. A long-term capital gains qualify dividends as ordinary dividends with taxable income above $1 million. That means that if you sell a property, you sell assets, and the income is over $1 million, they're looking at changing the long-term capital gains tax rate, which is now between 0 and 20%. And with property values as they are, if you do sell, how do you keep some of that wealth in? You want to talk to a tax professional about that. This one here, the next one, oops, let me go back. See if I can make this thing go back here. Oops, can you see it? Tax thing here, let's go back here. Okay, the enhanced child tax credit. As everyone knows, there's a lot of money floating out in the economy right now, right? Because of stimulus checks and rebate checks and SBA loans and all kinds of loans out there. Starting next month, people who have kids under the age of 6 and up to the age of 17 will be getting anywhere between $3,000 and $3,600 per child. And they can get that money in advance. So if you have 5 children, how much money would somebody be getting? So you want to talk to your relatives and your friends or yourself, and talk to your tax advisors, your financial advisors, on what to do with that money, and not just go out and buy something at the mall or go to Vegas. Also, the American Family Plan, this is where Biden is planning to increase the budget for the Internal Revenue Service by $80 billion over a decade to increase tax collections. So liens, levies, garnishments, collecting, taking over accounts. The IRS will be pushing more towards collecting money. I think there's $1 trillion tax gap between, the tax gap is what people are filing and what they know people are filing. The amount of money that's missing there is up to $1 trillion now. So this is going to be good for us because we'll do more representation. And these are just some of the other, and I won't go through all of these right here, but these are some of the other proposals that you probably want to speak to your tax advisor about, before the year is over. Because there's a lot of things that Biden plans on. He's giving all this money away and giving all these tax breaks. They're going to pay it some kind of way. So you really want to be conscious of what that is and speaking to your tax advisor. If anybody has any questions or needs part of this slideshow, I'd be more than happy to email it to you. So reducing your taxes, paying as much little taxes as possible. Some of the first places to start is look at taxes like this. I like to keep it really simple. If you put all your income in a basket, wherever that income may be from all sources, from active income, passive income, W-2s, interest, dividends, rental income, retirement, capital gains, gambling, Social Security, unemployment, you name it. Put it all in a basket. And getting back to my general philosophy here is what's left in the basket at the end of the year. Well, the IRS has rules and guidelines that you can use legally to take items out of the basket. And when we take the items out, and we won't go through all the tax deductions, we'll go over some of them. Whatever's left is what we pay the tax on. So and the best way to do that is to use the tax codes, Roth IRAs, municipal bonds, health savings accounts, 529 plans, exclusion of $500,000 if you happen to sell a property. There's all kind of tax codes where your money won't be taxable. 401ks, your money comes out of your paycheck before you even put it into your basket. So you want to be aware of the types of incomes that you have, what's going in the basket, self-employment income. Should you be a Schedule C, self-employed, or should you be a K1, an S Corp, or a partnership, or an LLC? All of those different types of entities, and of course, trusts, have different tax consequences that you want to be aware of and talk to your professionals about before the tax filing for those returns. And there's probably, I don't know, 172 different returns filed throughout the year. It's not just your 1040s. So there's a lot of different returns. Okay, so how do we get stuff out of the basket? And this is hitting, because I only got 15 minutes here. Hit on some of these items here and I'll go over them briefly. The most popular one is itemized deductions, medical expenses, state property taxes, personal taxes, mortgage interest, points on your house, contributions of non-cash and non-cash, and tax credits. So instead of renting, we're talking about accumulating wealth. So do you rent at $3,000 per month, or do you own property? Well, when you own property, the interest part of your monthly payment is deductible. The property taxes of that are deductible. A lot of people don't realize that this passive loss rule right here, if your income is over 150,000, you have rental properties and you have a loss, can you write off the loss? And normally you can't. You start losing rental losses after your income gets to a certain level. So those items take planning with your tax professional, with your financial advisor, with your estate planning, because all those losses that are accumulating, when do you eventually cash them in and utilize them? Capital gains. Do you realize that when you refinance your property, and I'm not advocating anybody to go out and pull the money out, but when you refinance the property and you pull out $250,000, is the income taxable? Is that $250,000 taxable to you, or is it tax-free? I'm gonna leave that question for later. Maybe we can get to that. Business losses, S-corps. What type of entity do you have? And Gerald will probably get in a little of that later. But the entity type that you have for your business has a lot to do with the tax liabilities. A self-employed, a Schedule C owner will pay a lot more taxes on that net income than somebody who has an S-corp. Where's your K-1s come from? So again, all of it gets back to what goes into your basket, what comes out, and what comes out or doesn't go into there has a lot to do with who your partners are, professionals, tax professionals, and investment advisors, on lowering your overall taxes for each year and also for your estate, because we do estate tax planning also. Cash contributions, non-cash contributions. So this kind of gets into the benefits of wealth building, of ownership of property. And when you own a property, you're gonna have a better chance of, and I'm hoping I don't get too technical here, of having a Schedule A, which is your itemized deductions. So your Schedule A takes more items out of that basket, if you want to put it that way. Your medical, your contributions, your casualty, theft and loss, your property taxes, your gambling winnings, your interest on your home, your points. The list goes down and down that you can write off. As we talked about, rents are not tax deductible. So as your kids, your family members, young people out there that's listening to this webinar, really consider buying some type of property and stop throwing that rental money away every month. All taxes, including property taxes, are deductible. So that's income tax, state income tax paid, right? Property taxes, taxes on your car, taxes on your boat, taxes on that big mobile home that you have, taxes you pay to the state of California, which changed a little bit with Trump law, but hopefully Biden will take that back. We talked about return on your improvements into your property. When you put the brick $15,000, $20,000, $40,000 driveway in, is it a tax deduction? But when you do it on your rentals, it is. On your primary residence, it is not. But when you sell that property, what happens to that $40,000? You got to consider that it's going to appreciate with the property. And because of the exclusion of some taxes when you sell, if you sell your primary residence and move up with the properties, that $40,000 is going to increase in value. You don't pay any taxes on it. So capital improvements are not taxed when the properties are sold. Some people will sell a property every 2 years to to exclude and have 250 or 500,000 of tax-free income. When you own property, you're going to appreciate, the appreciation in the property is part of your building your wealth. We talked about when you refinance, is that income tax-free or do you pay tax on it? And of course, the increase, owning property will increase the value of your estate. So minimizing your taxes is the key to accumulating, or part of the key to accumulating wealth. We only deal with the tax part. Trish and Daryl and everybody else on this thing will help you accumulate that wealth. Our job here is to help you not pay tax on it or minimize the tax on it. So in closing, you kind of want to know where your income comes from, know the difference between gross income, total income, adjusted gross income, modified adjusted gross income, and taxable income is the key. That's what we want to lower all the time. So meet with your tax professionals and work on a plan to lower your taxes, potentially get a larger refund. Remembering refunds are just money that you're loaning to the government. So you're really not, that's not the best use of your putting your money away for a year and not earning interest on it. So with the proper planning, we can minimize your withholdings, not have any taxes when you file the tax return, and actually you don't have a large refund, but your money's still been in the bank working for you. So I'm looking forward to any questions that we may have later down the road. And just send that you can take the screen back over if I need to stop it here. Stop sharing, here we go. And Gerald is going to get into some interesting concepts and theories and mindsets on accumulating wealth. And hopefully the tax part of this will assist you in the future. And if you have any questions at the end of the show, we'll be more than happy to answer them for you.
Thank you, David, for that presentation. Our next presenter is Gerald Brown. Gerald Brown has 47 years of extensive experience in diverse leadership and management roles within the banking world. So if you want to know what's going on inside the bank, he's the guy that can tell you. He's an outspoken advocate for identifying new markets for individual customers, businesses, and various financial needs. Post his retirement as Senior Vice President of the Southern California region for U.S. Bank, Gerald remains active as an agent for change and economic parity in the underserved communities throughout his new platform of positive change that he entitled The Rewirement Project. And stay tuned for more about that. So Gerald's going to spend the next 15 minutes talking to you about how to build wealth based on home and business ownership and all the intricacies that you need to know to do a good job of doing it. Gerald? Unmute yourself.
Okay, great. Can you hear me okay? Is that good?
Yes.
Hey, good afternoon, everybody. Gerald, thanks very much. I couldn't be more pleased with the work that you're doing, with Parkside and your partnership with Urban League, who is just amazing in the leadership of Michael Lawson. It's just been phenomenal. I know everyone that's listening right now wants to understand money. I'm happy to play a role in talking about that, and I'll give you some different perspectives. But I would be remiss if I didn't acknowledge all the other panelists, that not only David Murphy, who I'm really excited because he set the table for me to address some things, to compliment some things that he introduced to all of you. But when I think of Caprice Collins and BJ Hawkins and the years of experience, like Caprice, I'm a native of Los Angeles. We both went to the same high school, Dorsey High School, grew up in the Crenshaw area. BJ and I have done many panels together. And of course, Justin Lacey and Joe Haywood. So I would encourage all of you, to make sure that you participate. So let me tell you what I'm going to do. I've got so much that I could share in 15 minutes. So I'm obviously going to provide some broad generalities and hopefully some meaningful specifics for you to better understand wealth building tenets, as well as some of these small business kinds of things that are really important. As Gerald said, I'm Gerald Brown, 47 years in banking, financial services, and I recently started something called the Rewirement Project. And let's go to our first slide. And And the Rewirement Project is a sort of a made-up term, but it really is a colloquialism for change, for transformation, for how we transition and how we embrace goals and how we overcome some of the barriers that oftentimes are self-imposed. So in my new platform, I'm now building my website, so you'll go look for me. I'm not there yet, but I will be in a couple of months. But you can write this down, Darrell, D-A-R-R-E-L-L, there's no Y, at therewirementproject.com. I'm a life coach, executive coach, I'm management consulting. I work with a lot of small businesses. I speak all over the country, and there's nothing more that pleases me than do this work to serve all of you. So I have a big responsibility tonight. One, I want to acknowledge all of you. I know you could watch the basketball game, spend time with your family and your friends, but you've made a decision to spend time with us. So I can assure you, David and I feel an obligation to give you your time's worth. And I'm hopeful in the time that we have, we'll be able to do so. But I'm also very interested in kind of questions that you might have. That really gets me going to make sure that we're addressing and identifying the things that are important to you. Let's go to the next screen. So I want to take a look at this. And by the way, I tell people that what you hear, you forget. What you see, you remember. What you do, you might understand. This one here, as Justin Lacey said earlier, that we want to talk about some behavioral kinds of things. I'm not a psychologist, I'm a coach. I'm going to be real clear to that. But there's a lot of things that goes on between our ears that handcuffs our ability to move forward. And so let me just give you perspective and tell you why I do this work and why I'm a coach, why I love banking. And I want to go back to my years as a teller, which was 49 years ago. And I remember there was a lady that approached my teller window. And this is during the days in which I didn't have a computer. There were no computers. And she approached my window and she says to me, and she was very emotional, she said, "I want to close my account." Now, of course, my job is to save the relationship, but she was adamant that she wanted to close her account. So I turned around, and back then we had journals, and I had to get my ruler, find her account number, and I found her balance, and her account was overdrawn. So when I went back to the window and I brought this to her attention and told her she was overdrawn, and I said, "Ma'am, to close your account, you're going to have to make a deposit." And when you think about that moment, there are many people that are challenged. Well, the branch manager recognized that something was going on. He came over and took her to the platform. And I watched him discussing a lot of things. He put out some forms and started discussing with her. And I found out later that she had was going through an extreme divorce. Her kids were in the car. This is, life is always in session, folks. The husband beat her to the bank, and she had to take care of her kids. This is real. And what that branch manager did is helped her fill out a balance sheet, helped her fill out an income statement. He proceeded to grant her a loan. And it was in that moment I knew that financial services, understanding economics was something that I wanted to do because I knew that I can make a difference in the lives of those, particularly in the urban communities. And one of the things that I'm going to ask of all of you, and this is your homework. I believe in homework. I believe that what we say to you is information. It doesn't become knowledge until you put whatever you hear from me or David or the others in the coming months, unless you put whatever we say to practical use. So here's your homework to start. And this is for individuals and for businesses. It's the same thing. And I'll show you how banks underwrite and what to think about in just a moment. Get a piece of paper, draw a line down the middle. On one side, you call it assets or income. On the other side, you call it liabilities or expense. In accounting, David, you might recall, we call it T accounts. That's the basics of us better understanding what people have. This is also a picture of where you are. I think for us to do anything in banking, for us to assist you in your wealth accumulation, we need to understand the basics. So again, many people call this, the balance sheet or income statement. You know what I call it? I call it the truth. And you have to have a good dose of the truth so you can start where you are. I don't care whether you have assets minus liabilities. If you're in the positive, that's great. Or if you're underwater, wherever you are, start right there. The truth will set you free, and it gives you an opportunity to correct the old errors in your financial judgment. There won't be any judgment on my part or my fellow colleagues. It's going to give you an opportunity to rethink and make yourselves a priority, because most people work harder on their jobs than they do on themselves. Let's go to the next screen. And go back. Just saying, I want to say one other thing. I just want to say something. The heaviest burdens that we carry are the thoughts in our heads. Again, I'm not a psychologist, but I have studied success. I ran a $20 billion portfolio with thousands of employees, millions of customers. And I've made it a purpose that to be successful, study success. And when I ask the people of great wealth in business, in owning corporations, or wealthy individuals, they have a real good understanding of what goes on between their brain. They know when the voice of procrastination enters, or complacency, or doubt, or fear. They can manage all of those kinds of things, which is why I was so happy Justin mentioned behaviors, because they make all the difference in the world. Are your thoughts intentional or are they unintentional? You were purposeful in joining this call because you knew there might be a nugget that would disturb you to take action in your pursuit for financial independence. I love sharing images because, again, when you see this image, the burdens that we carry are in our head. And the way you sort of lift that head up is to leverage people that are resourceful. Let's go to the next slide. I got your back. I got your back. And I say that with all my partners. But here's a real question. Who's got yours? When it comes to finances, when it comes to your financial well-being, the choices that you make in buying a home or building a business, starting a business, sustaining a business, estate planning, which is so crucial in everything that we do to create a legacy. Who's got your back? When it comes to your medical practice, or if you're sick and you've got issues, you got a physician, you got dentists, maybe your family members, your kids. But who's got your back in the financial world? Well, I can assure you that, again, I have your back, but it's important for all of you to pause and list the people that you know are experts, people that you can trust, that you know have your back when it comes to your future, your life, in areas that you can achieve high levels of aspiration as it relates to your financial goals. Let's go to the next slide. Here's the basic wheel of financial wealth. I can't go over all of them tonight. You've heard a little bit from some of all of us. I'm going to focus on financial planning and some of the subsectors within the financial planning area. And I'm going to talk about credit and lending. David talked about taxation. Retirement planning by itself is a whole nother subject. Taxation, retirement planning go hand in hand, particularly if you are working for a company. I hope all of you get involved with a 401k. It is tax deductible and it's also tax deferred. So if you make $100,000 a year and you've got a 401k, you got $10,000 on it, you're going to be taxed on $90,000, not $100,000. And sometimes the companies match. It's free money. So make sure that you take a look. April 15th, most folks open the IRAs. Question is, how many IRAs can you open in 1 year? Most folks will say one. I say two. One for the previous year and one for the current year. Because if you're moving money from your savings account, it wasn't tax deductible. So you're losing thousands, tens of thousands in tax deferred accumulation. Education, we talk about our kids. I'm going to talk about that a little bit. Insurance. If you don't have life insurance, I guarantee you got car insurance or house insurance because it's required by law. And insurance is the only product that creates cash when none existed before. Think about that. Everything else requires the element of time and time value of money and all those kinds of things. But you be mindful When you think of taxation, you think of credit, you think of financial planning, know this: whatever you have today, there's an invisible hand inside your purse and inside your wallet every single day. You can't see it, but it's there. It's the invisible hands of taxation, the invisible hands on the interest costs on debt, whether it be your loans or your credit card, and the invisible hands of obsolescence. And what that means is that things get old and need to be replaced, whether it be your roof or your clothes, and it requires that we get to an area where you have liquidity to address some of those things. Let's go to the next slide. Big five of money. This is it. One of my dear friends is named Ed Austin. And Ed and I go way back, and I want to give him kudos. This is not something that's new. It's something that we all know, but he breathes a lot of life into this. What you earn, what you spend, what you borrow, what you save, what you invest, and what you protect. A lot of folks have more month at the end of the money because they haven't put the plan together, business or personal. So what you earn is really important. So if someone asks you how much money you made, chances are you're going to give them a gross number: 100,000, 150, 90, 50. But you and I both know those invisible hands are at work. And I want you to start thinking about the net number. And we're going to get into some other things in just a moment, but how you borrow, smart borrowing, look at the interest rates, because the marketing machine in the world of banking is intended to make money. But you have a choice to understand all of this. Saving and investing and protecting is really important. Gosh, let me just keep moving fast. There's a lot to cover in a short period of time. Let's go to big five of money. Let's go to the next slide, rather. Here's some basic rules of money. Pay yourself first. It speaks for itself. Learn how to invest. There are books from Wall Street. There's books from the Wall Street newspaper. There's so much information on the web about learning how to invest, the type of investments, and how you get your kids involved in those kinds of things. Give every dollar a job. Spend less than you earn. Have a plan, set goals, keep your finances organized. Let me talk about kids for a moment. Let me go back to the balance sheet. Give your kids a balance sheet. Here's the change and here's the difference. Call it assets, income, liability, expense. But for them, call it allowance. Give them $20, a week, whatever you do. And make sure they understand why that's important. And then on the other side, expenses. What are they going to spend their money on, which means they have to have a goal. Let me give you an insight on how you can really get your teams engaged. How many of you actually tell your kids how much money you make? Oftentimes we don't. Tell them, get them involved so they can understand taxes. I used to show my kids my utility bill. And I remember when they were young, they're 42 and 37 now, we had a light bill was $137. And here's what I told them. What do you think we need to do to lower this light bill? They said, well, Dad, cut off the lights. And I said, whatever we can decrease that bill by, that's what I would do to increase your allowance. What do you think happened when I came home every night? Yep, that's right. All the lights were off. They got it. These are the kinds of things that I think you can do for yourself and understand where your money actually goes. These incremental expenditures add up. And if you understood these basic rules of money, to understand where your money goes, you'll be amazed how much money you can accumulate. Let's go to the next slide. Have an emergency fund. Always make money work for you. Learn how to make money passively. In fact, that's something that David Murphy just spoke to. Owning real estate or finding a way alternative, or a small business, investments. Use it to solve problems in the world. Don't use credit if you don't have cash. I used to be amazed how many people would take a cash advance for Christmas and they're paying for the previous year's Christmas in the current year. And banks love it, but it doesn't help you. It's not what you make, it's what you keep. Let's go to the next slide. I've got there's so much I want to share. Please go to the next slide. Don't save what is, thank you. Go back. Let's go back. Go back one slide. Don't save what is left after spending. Spend what is left after savings. Have your priorities. Let's go to the next slide. This is one of my favorite slides. You know what it takes to waste $10,000 a year? Spending $27 a day on stuff you don't need. Let me give you another perspective. I used to drink a drink many years ago called Super Sacco. It's like lemonade, like Gator. I was addicted to it. I'm not anymore. My doctors won't allow it. And it costs $1.50 a bottle. $3 a day. How many days in a month? 30. You know, so 3 times 30 is $90 a month on Super Sacco times 12. I always multiply it by the number of months in the year. $1,080 in Super Sacco. I thought about all these subscriptions, you know, to whether it be Ebony Magazine or Jet or some of the ones in my younger years. All these magazines I thought I would read and never did. And they charged my account automatically. And they kept sending renewals before it was over. It's costing you hundreds. If you're a senior citizen, you know they have senior citizen discount for your cable bills, your phone systems. You'd be amazed what you can do by just understanding and having fun with how you save money. My son, whatever the day of the month it is, that's the amount of money he puts in a savings account. So on the first of the month, it's $1. Second is $2. On the 15th, he puts 15. On the 30th of the month, it's 30. If you were to calculate that, it's going to equate to about between $500 and $600 times 12. So when I think about what we can do when you understand and have fun, I never spend change. I break a bill all the time, put it in a jar. It adds up on the average to about $700 a year. So when you start to think about the power of money, you know, you don't have to wait for a rebate check. You don't have to wait for PPP. These are the kind of choices that you can make right now. These are just the basics of it. And all the people of great wealth, oftentimes being called cheap. No, they're not cheap. They just have a clear understanding of what's important for them. Let's go to the next slide.
5 minutes before Q&A.
Oh my God. Rule of 72. The rule of 72 is a way for you to determine how long it takes for you to double your money. And here's what I mean by that. If you have money and you're getting, let's say 6% on your money, it's going to take 12 years because 6 times 12 is 72. If it's 8% of your money, 8 times 12 is 72. So just understand the rule of 72. If you look at the 72 as your numerator and the number of years you want to double your money, which is division, then the end result is going to be the interest rate that you need to get in your savings or your investment to achieve your goal. Let's keep going. Next slide. A dream written down without a date becomes a goal. A goal broken down into steps becomes a plan. A plan backed by action becomes a dream come true. Everybody on this call has a dream, the same goal. A lot of money, whatever that is, big house, vacations, good health, take care of the kids, send them to college, take care of the parents, world peace. Pretty much everybody has the same things. Here's what pulls your heartstring. The next question would be why? For every goal you have, ask why. The reasons behind the goal are stronger than the goal itself. Remember that. What's your purpose? And hold on to it. Next slide. They take me a little longer, Gerald. I love this slide. I know you can relate. Whoever lost a bundle of $100 bills tied to a rubber band, I found the rubber band. People will steal your money. You can't loan your money to Pookie. It ain't gonna come back. And by the way, if somebody's on a phone call or this Zoom call named Pookie, I'm not talking to you. I'm talking about to the other Pookie. What I'm just saying to all of you, be mindful of how you interact and how you use your money. Respect your money. There's a lot of people out there that run scams on your phishing processes on your computer. Just be aware that people are out there to sort of dip into your bank accounts and understand all the protective platforms. And you want to understand that. Lots happening out there, and I wish I had more time. Let's go next slide.
2 minutes before Q&A.
Rules of credit. Here's personal owned, small business, mortgage, credit cards. Let's go next slide. Here's the 5 C's of credit. Every lender, business, lending, personal, Gerald, I might need 2 extra minutes and hopefully that's okay. Character, we looked at willingness to pay, your capacity to pay, your ability to pay, your net worth, which we talked about. A lender for business needs to understand your business, your industry, your economy. If you come to a bank and want to get a loan for a Blockbuster video or Kodak film or a phone booth, you're going to be declined because those industries know what happened. And then, of course, collateral is going to be based on the fair market value of the pledged assets, loan to value. If you get a home for $1 million, we loan you $800,000, that's an 80% loan to value. Debt ratio is your income. If your income is $100,000 a year and your bills are $50,000 a year, that means you got a 50% debt to income. Banks like to loan at 40%. Let's go to the next slide. Rules of credit. Check your credit score before you walk into a bank. Pay down your debt. Be honest. I won't tell you all the stories where people just manufacture numbers on the tax returns. Income. And of course, your credit history. Let's go to the next slide. There's different kind of lenders, asset-based lenders and income credit lenders. Banks are income credit lenders. Asset lenders look at all the value you have in your house, and they will just, like if you have a $1 million home and you only owe $400,000, they'll make you that loan no matter what your credit is, but they can't wait, to attach your home. Lender's product is money, and we give you money and we pay later. Those are promissory notes we sign. 85% of small businesses fail. And I have some statistics to talk about that, particularly for African Americans. And just don't walk in and say, well, just give me whatever I qualify for. It doesn't work. Have a specific number so you can help educate the bankers on what you have, the work that you did, and your likelihood of getting approved is going to be increased. And understand your financial projections and sound assumptions. Keep going. Rules of credit, available date tax returns, up to date. David talked about income tax, having an avoidance strategy, but we're going to look at financial statements. And by the way, if you don't show any profit for a small business and you wink at me and say, well, I really make more money, I just want to pay taxes, we can't help you. That's what happens often, but we have to depend on financial statements by law. There's so much regulatory kind of compliance that governs banks to make sure we operate and underwrite in a way that protects the bank and protects you, the client, so you don't get caught up in any other crazy things. Next slide. This is my last slide, one more after this one. Everybody's committed to accumulate wealth. I know that, but there's 5 levels of commitment, whether it be a small business, whether it be a person, whether it be a nonprofit, and there's called the think about it level. After this call, some of you are going to think about what I said. That's a level of commitment. Some of you are going to try some of the things that we presented to you. Some of you are going to do what you can. Some of you are going to do what's expected. But it's the 5th level that I really embrace. Those are individuals that will do whatever it takes to make a difference. That means to follow up with professionals, experts in the areas on that wheel that can bring value, that have your back. Last slide. Go ahead. Next slide. A dream doesn't become reality through magic. It takes sweat, determination, and hard work. Colin Powell's got some brilliant stuff on leadership. It's one of my favorite quotes. And right now it requires the hard work for all of you to achieve your financial goals. Those are some broad generalities. I'm anxious to get some questions and hopefully we can address those. I know it took a little bit longer, but Joe, I'll turn it over to you and maybe we can open the lines and see what people are thinking about.
Hello, everyone. My name is Jacinda Moten. I am the virtual producer for tonight's event. We will now begin the Q&A portion of the program. Thank you, Gerald and David, for your wonderful presentations. Now, if you have any questions, please write them in the chat, and I will double spotlight Gerald and David. And let's see what questions you have. Jonathan Carr mentioned, what are some good books that you recommend for the youth?
Oh gosh, there's a book called Powernomics. Well, I'm not sure how you define youth, but Powernomics by Claude Anderson is one that comes to mind. There's a number of books produced by the Wall Street. These are great books. They're very small, but very powerful. They talk about personal finance. All my son's friends, I gave those as gift for their college. And it goes from the beginning of money from barter platforms to current day. I would also engage all of us to get more familiar with digital money and cryptocurrency. I'm not the expert. Probably Justin Lacey can speak to it. I do have a Robinhood account. I'm learning it myself, but it's going to be the way of the future. There's a lot of materials that's out there, but I would say those are the first two things that come to mind. But there's a host of books when you just Google books that specialize in personal finance, wealth accumulation, investment strategies, owning a home that really come to mind. Claude Anderson is brilliant. There are a few others out there. Why Should White Guys Have All the Fun, which speaks to the first Black billionaire. And he goes into all kinds of things for business owners on how to acquire business and other lending platforms beside banks, like non-traditional lenders. And I won't go into that, but there are other lenders that beside banks, for those of you that seek credit, that also can accommodate your goals, like CDFIs, community development financial programs that do amazing work to grant capital and access to capital for small business as well.
Great, great.
I would,
Oh, go ahead.
to answer that question real quick, I would recommend using the internet because you can be really specific now on what particular areas of financing or money that the youth are, on every day. And there's games, there's all kind of stuff. So I would recommend that also on top of the books.
Yeah.
Great. Here's another quick question. How do you see inflation affecting people in the coming years? And what should people know about it while preparing themselves financially?
Ooh, Daryl, you can get on that. I have a brief comment on that one there. I don't worry about it.
Yeah, go ahead.
I basically tell my clients, it is there and you have to watch the indicators to see when it's going to happen, but you really should be focusing on, what you need to do to succeed. And I'll let this 40-year plus banker tell us
great
that.
Question. I think, I think working with those in the Treasury and all the great minds in government are trying to keep inflation down. And but I will tell you there is going to be a challenge. If it does grow and you see inflation, it's going to be incremental. Traditionally, you see inflation at 25 to 50 basis points. Right now, it is so low, it's not going to have that much of an impact. I do think as people come back to work, and we start to really drive this economy, I think you're going to see a slight increase, in the inflation rates. You might see an increase in some of the interest cost. Lately, it's been up and down, but keep in mind, over the last many years, it's been zero and close to zero. I mean, in savings accounts, you only get 1%, and lending is not that high either. But you're going to start seeing slight increases over the next couple of years. But again, there's so much materials out there from California economy, LA economists, as well as world economists, United States economists that can give you more detail on the triggers that will impact inflation. But I think it's going to be a great space. This is a time, I was reading something today that mortgage rates are going to lay flat. For those of you that can find property, get into a home. For those of you that are starting a business or want to sustain your business, try and get access to loans because the interest rates are relatively low, whether it be a loan or a line. So, there's some flexibility for those of you that leverage lines as a resource for access. But I think it's going to be relatively flat based on some of the analysis I've seen over the next few years.
Great. Here's another great question. How can you legally avoid the pitfalls of Proposition 19, which was passed last November? This proposition reassesses property left to children to the current value if the child elects not to live in the house as their primary residence.
David,
that's a property tax proposal that passed in Los Angeles or California, where the tax basis of the properties will increase with the person passing away and how they set it up. A lot of individuals was handling that before that law passed. They were setting up the trust and doing different things to avoid it. I've read up on it. I'm not that familiar with it because I was busy with year-end planning and we're still doing 2020 taxes. But you can contact me. I think I asked you for your email. I'll be more than happy to give you the details. But I think you'd want to bring all of your facts to the table first to somebody like Mrs. Collins and the other people here, because you want to get a big picture on what you want to do with that as far as I don't know whether you're inheriting a property or it's your property, but that's my recommendations for that. My
Or
comments on that.
even how you hold title, because there's a lot going on in terms of when they say tax basis, it's, somebody bought a home 50 years ago, it's going to be a lower price than today. And, and if you sell it, so sometimes there can be an increase in basis depending on what happens, upon demise. And that speaks to some of the estate planning kind of realities. And I know Caprice is far better than I that can speak to some of those kinds of things and how to hold title and how that might link up with some of the new tax changes that are beginning to take place, particularly as it relates to kids and having a legacy strategy, because there's still going to be some tax consequence.
Caprice, do you have a comment on that question?
Well, I would kind of agree with David. The ship has sailed in some respects because the law became effective back on February 15th. And there was a lot of aggressive planning by various individuals to preserve those assessments. But I would say that the law is not final. There was a lot of ambiguity in the proposition. And I believe there will be some significant litigation regarding Prop 19 before it's absolutely final. The only other way, of course, if you believe that the new law will stand, is to plan to leave real property such as single family homes to a family member who will reside in it, and then they will continue to receive the assessment up to a certain limit. They're right now are saying that the property has increased more than $1 million from the time the original purchase, that there will still be incremental tax increases on that property. So right now, say things are not as definite as could be. A lot of potential litigation still standing, but I think it's very important to recognize not only Prop 19, but many other tax implications and consequences that we can give great attention to estate planning to try to limit that burden on the family and to preserve as much wealth as possible.
Great. Another question is, how do you determine withholding allowances on a W-4 form? David?
Sure, I can answer that. That's a good question. Well, two things. When we're talking about tax planning for the future, you would determine, don't let me get too anal here, but you determine your tax liability for the upcoming tax year. How much withholdings do you need per check that you're taking out? The problem with that now is that part of Trump's tax law and the withholdings, they changed how the W-4 works now. So you don't have that. Remember, you used to be able to go, oh, I'm single in 1 month, you might go 8, next month you might go 7, or you might go exempt. Well, that whole form is different now. You can only pick basically your filing status and your exemptions that you may have. So probably the best way to answer that question is to meet with your tax advisor and kind of project your taxes, determine what your overall taxes will be, and then you break that down per paycheck for the rest of this year, or pay estimated tax payments. But to answer that question, yeah, that's why a lot of people are having a problem with that W-4, especially if they haven't changed it in a while.
Okay. Another question is, what are the pros and cons of using a Roth IRA or a Roth 401k contributions versus a pre-tax IRA or full 401k plan?
I can give some of that question. I think Gerald can maybe tie on the back end here.
From a tax perspective.
Well, both Roths, the money is whatever money you put into those accounts, it's not taxed if you meet the guidelines for it. You're over 59 and a half, you've been in it for 5 years, it comes out tax-free. The pre-tax IRA and the 401k puts it into the same place where it's pre-tax, but you're going to pay tax when you come out. And the pre-tax IRA, you're writing it off on your tax return. So the way that we do normally with something like that, we'll work the numbers for both sides. A lot of it depends upon the interest rate that you're going to be earning in your retirement accounts and how long you have to retire, your life expectancy. A lot of factors go into determining which one is best. So again, I hate to keep saying it, but it's the key. Meet with your advisor. Your financial advisors may have projections on their programs, projecting out your financial planning, and we can do it from a tax point of view to tell you what the tax hit would be. But first you need to know what the money is going to do and what amount of time is it going to take to earn.
And Daryl,
Keeping my answers pretty short here, but.
did you have anything to add, Daryl?
No, I think that summarizes. I think that it's just important to understand pre-tax versus after-tax. You know, because when you get to tax deductibility, you know, and you don't pay taxes when you put in IRA, a traditional IRA, then it's tax deferred. You don't pay taxes on it; it's just taken off. But if you do a Roth IRA, it's after tax. And so you just need to understand those two dynamics, you know, in making those decisions that's unique to you and your personal situation.
All righty. Another question is, do you have any opinions on the expansion of community land trust, and do you recommend them?
Wow, that's a good one. I'm seeing them evolve, and each one is structured a little bit different. And a community trust, depending on how they're funded from various grants, a lot of banks might invest in grants. You might see a very unique financial structure that's built around a certain purpose. I know that in Arizona, for example, with some of the community land trusts that are beginning to evolve, we're seeing things that I've never seen before, is they're building homes for the sole purpose of renters. In fact, they had something on the news the other day where instead of apartments, they're building these homes because the cost of homes are just increasing to a certain point. You're seeing more creativity emerge in community land trust. And let me tell you one of the reasons behind this, and I've been watching this a little bit closely, not an expert in that particular area, but the average rent in LA is probably approaching $3,000, which means that you have to earn $75,000 a year just to afford the average rent. So when you start thinking about labor force, you start thinking about where people are going to live, and where you have affordable housing. Most of these kind of homes are like 2-bedroom. I'm really, really excited, that community land trusts and how they're structured are beginning to emerge and in open spaces. I'm not seeing a lot in LA per se, because the land is quite pricey, but there's going to be some contingencies that emerge in the near future around community land trust.
All righty, and this will be our last question. My husband and I are in our early 20s, and we're currently saving for our first property. Is it smarter for us to buy a single family home or buy a fourplex and a house hack?
I'd have to sit down and look at your situation. For young couples, I will tell you, I know many young couples that bought an apartment building if they can afford it, and you live in one and you got somebody else paying the rent. Yeah, I mean, it's you got a little bit of passive income coming in to offset your note. I mean, there's some wise things. If you're in a market, where you're going to get fast appreciation and you've got a foreclosure or estate sale or something where you can get a home that's under market and you think you can project the best of analytics, that's just going to be some appreciation. It just depends on your situation. If you're going to have kids and you're a young couple and you don't, I'm not personally apartment kind of guy, to live, but that doesn't mean that it's not unique to you, because right now the appreciation of property, and they're not building not making any more land. So whatever you can get into, make it happen, and what you're comfortable with. But I think, again, it requires maybe some one-on-one sort of dialogue to kind of get a sense in terms of where your financials are, what you can afford, what makes sense, and for you and the lifestyle you wish to lead, whether it be a single family, whether it's going to be a 4-unit.
Great.
Any comment, Dave?
Yes, most definitely. I'm with Gerald. I think it depends on your situation, your type of lifestyle, and what you can qualify for. The fourplex, you might qualify for more of it. Well, let me back up. I'm also a broker, and we have a branch office with C2 Financial. So I'm the owner and operator of that. So getting back to the question, depends on what you can qualify for. I like the fourplex just on the surface, buying that if you can qualify for it. One, you can eventually move out, that unit will become rents, and you have the income from the other 3 units that would increase over time and help you qualify for the home that you would eventually want to get into. But again, I'm with Gerald. I would really want to look at your details and run an analysis on, I'm real big into quantifying answers running the analysis on each scenario on where you're at.
And depending on how you're structured, you might have an investment company. There's going to be some tax deductibility by having those other units and all those kinds of
Exactly.
things. You can deduct based on the income that you're coming in. So deductibility is always going to be key.
All righty, well, thank you, gentlemen, for your insight and your knowledge. We greatly appreciate it. That now concludes the Q&A portion of the program. I will now turn it over for closing remarks with Reverend Gerald.
I just want to thank everybody for participating, and I want to thank our speakers and all of our panel for contributing to tonight's event. We want to make sure that you register. If you haven't already, those of you who have registered, I'm sorry, but I want to make sure that all of you who are on this call, make sure you talk to your friends and family members and other people in the community and tell them that what we're trying to accomplish here by helping them build legacy wealth for their families, and tell them to go on laul.org/BWARP and register for the upcoming events, and particularly the one that we have coming August 12th. I will, if you trust me. And the reason Michael Lawson and I got together to do this was because we wanted to kind of stem the tide of those of us who have accumulated a home or some wealth or a business and seeing it go away versus being passed down from generation to generation like the other groups tend to do. And we tend to do a little less of that. So it's going to be a very interesting workshop. So spread the word. And now I'll turn it over to Michael Lawson for closing remarks.
Thank you very much, Gerald. And thank you, audience, for attending. We trust that you enjoyed this afternoon's presentations of our Black Wealth Attainment and Retention Program. Thank you for attending. Please give our speakers, Mr. Gerald Brown and Mr. David Murphy, a round of applause. And thank you, Daryl and David, for your expert presentations. Thank you again, Gerald and Brian Williams, the Los Angeles Urban League Chief Operating Officer, for your leadership in presenting these resourceful workshops to our communities. We hope that this afternoon's presentation will assist you becoming more comfortable discussing wealth building with your families. We are not content with these workshops to only diagnose the problem. We are determined to transform the manner in which the Black community behaves regarding wealth building. We also hope to assist you navigating a transition from savings to generating income, which can result in an income stream that can be passed on to your heirs. We've got your future on our minds, and we hope to provide you tools and insights that can help chart your ways towards a robust wealth building mode of operation. We hope that your attendance at these workshops will reimagine and energize the manner in which you think about wealth building and financial literacy. We can't think of a worthier pursuit. Again, join us in August for our 4th installment in this series. I bid you a good night and thank you for attending.
Good night, everyone. Thank you.
Good night, everyone.